exploring unbalanced strangles. We've been getting a lot of questions lately about skewing positions to make them a little bit directional. And I completely understand that because I like a little bit of a directional bet every once in a while. And I like a directional bet. And I like using strangles to make directional bets. What does that mean? That means, okay, I'll sell sometimes a bigger call than put, and sometimes I'll sell a bigger put than a call. That's how you make a directional strangle. That's how you unbalance a strangle. It's not like I'll sell 10 puts and 5 calls. It's more like I'll sell a 30 delta put and a 10 delta call, or a 30 delta put, a 16 delta call, that kind of thing. That's how you skew it. And what we decided to do today was take a look and say, hey, how does that work? Assuming you don't know what the market's going to do, how does that work?
Let's find out.
We've experienced one of the biggest bull markets in the past decade. This has made all bullish strategies, such as naked puts or covered calls, look more attractive due to the large bias to the upside, okay, long deltas. So that's why a SPY 30 delta put offers a richer premium than a 16 delta strangle, potentially leading to a higher success rate and better performance. All they're talking about here is that if you sold a 30 delta put, you collected 285, and if you sold the 16 delta strangle, only collected 249. So the argument here is, if I just sold the put, I did better, but it was a bigger put. Now, obviously, you have more risk. If you sold the 16 delta strangle, you have less risk. But if you just sold the put, you have no upside risk, just downside. Still,
only risk in one direction.
Yeah, in one direction. Now we're going to look. What if traders assume the market will keep going up, but they expect more volatility to the downside? That's kind of how we think. So they want to collect more premium on the upside while reducing the downside risk. One way to achieve this is by using an unbalanced strangle with overall positive delta. So how does this strategy perform compared to our go-to of a 1 standard deviation strangle? It's a pretty fair question. So to examine that, we analyzed 45-day to expiration SPY strangles over the past 15 years. We compared the performance of a 16 delta strangle with a 30 16 delta strangle. What that means is
a directional bias, one direction or the other?
Yeah, we compared selling 16 deltas on both sides, put and call, or selling the 30 delta put and the 16 delta call, all right?
Yeah.
Managed at 21 DT. So while the strangles with a bullish bias show a slightly higher volatility and could generate larger losses on the downside due to their closer break even because of the 30 delta, they significantly outperform neutral strategies in terms of return on capital. And again, this is a bull market approach in a market that went higher. And all that we're saying here is that if you sold the 1 standard deviation strangle, or you sold the 30 delta strangle, the 30 delta put and the 16 delta call, so it's skewed, the success rate's about the same. The annualized return on capital is significantly higher. It's 11 to 17. The volatility of the return on capital is about the same, and the largest loss is pretty close to the same. So if you feel very strongly that the market is going to go higher, and again, this is just, you feel strongly, you don't know, but if
nobody
you
knows
feel
anything
strong,
in this direction, sure,
and you wanted to take some risk to the upside, your return on capital would be significantly better if you skew the strangle. That's why we skew strangles occasionally, because we kind of think we have a feel. We don't necessarily know we do. We just think. So then we went out and we compared a naked 30 delta put to the 30-16 strangle. Compared to the 30 delta puts, the bullish strangles yielded lower return on capital and lower success rate, meaning that the losses on the call side diminished the potential profits. However, the bullish strangles showed much lower volatility, smaller downside risk, because the additional credit's obviously going to cushion the blow. If you just sold naked puts, the 30 delta put, you did a little bit better. The return on capital was better. The volatility was about the same. The largest loss was close enough to the same. So the argument here is that if you just want to sell the put, sure, go ahead. But you don't really give up that much by selling the strangle, and it might give you a lot more peace of mind.
Agreed. Okay.
You have a lower largest loss, but that's not that significant. It's just, you know what? It might just give you a little more peace of mind.
From what you've seen so far, do you skew anything in the coming days one way or the other if you don't have a non-bias on direction?
I always skew a little bit, but I'm usually a little biased. So next, we're going to swap the deltas of the bullish strangle and make it bearish. So how would a bearish strangle perform differently to a neutral and bullish one? So at a bearish strangle, you sell the 30 delta call and the 16 delta put. You just flip the cards over it. So the bearish strangles didn't perform as well compared to the other two strategies. Despite having the lowest volatility among the three, the return on capital from the bearish strangle was below expectations. And the reason for that was the market went higher. We were in a bull market.
Right.
So the annualized return on capital was only 5%. All the other numbers are kind of the same, even though your success rate's down. All they're saying here is, yeah, if you're short deltas, it didn't work out as well.
Yeah.
I mean,
that's just because the market didn't accommodate you. Sure.
Yeah, the market didn't accommodate you.
Right.
So some of the takeaways here. Bullish skewed strangles have a positive delta compared to neutral strangles. Thus, they perform better in bull markets than neutral strangles, despite the higher volatility. The bullish strangle is a strategy that falls somewhere between the naked put and the naked strangle, providing substantial returns on the put side, as well as better protection and lower volatility than a naked put. I don't think there's anything here that would shock you, surprise you, poke you, or stick you. But I do think that it's good to hear it. And it's also good to know that we do a lot of skewed positions, and it's totally fine.
Agreed. And you just said that you like to lean a little bit one direction or the other. You always have a directional bias on something. Agreed.